This is a student project by Group 4 for Dr. Ben Kaulo's Financial Statement Analysis course at the University of Zambia. The content presented in this video is for academic purposes only and should not therefore be taken as actual financial advice. The individuals who took part in this project are as follows, together with the roles that they played. Clive Philip was served as group leader, analyst, and presenter. Gavin Durumba served as researcher and data collector alongside Mario Banda. Then Jim Pio and Samuel Zara served as data analysts and data interpreters. In this assignment, we are trying to explore a retired investor's consideration to invest 1.5 million into one of the companies listed on the Lusaka Securities Exchange. In our case, we are a team of fictional financial analysts at CGJMS, and we have been tasked with analyzing a company, in this case Standard Chartered Bank, and to determine whether it is a good investment based on 3 years of financial statements. In order for us to do that, we are going to look at the background and overview of Standard Chartered Bank. Then from there, we're going to move to the quantitative analysis, where we look at the profitability analysis, liquidity and solvency analysis, efficiency and activity ratios, common size analysis, cash flow analysis, earnings quality, and any potential red flags. And then we're also going to look at the international financial reporting standards versus the generally acceptable accounting principles considerations. From there, we'll be able to draw a conclusion and give guidance to our would-be investor. So Standard Chartered Bank is a subsidiary of the London headquartered Global Group. It is the leading financial institution with over a century of operations in Zambia, as it was opened in 1906. Standard Chartered Bank is the leading bank in terms of digital banking and is the only international bank listed on LuSE in Zambia. From here, we're then going to move and look at the quantitative financial analysis for Standard Chartered Bank for the years 2021, 2022, and 2023. So now, these reports, you'll find a link attached in the comment section. Please feel free to peruse through the annual reports. The only thing we have provided here are only extracts from those reports. So to kick off the quantitative analysis, we're going to look at the profitability analysis. Here, we're going to look at the return on equity using the 2-point decomposition. So the 2-point decomposition is used to analyze the company's return on equity because it moves beyond a simple surface level metric, and it breaks down into its core operational efficiency and financial components. The most critical question that the 2-point decomposition answers is, why is the company's profitability the way it is? So the 2-point decomposition return on equity formula is return on equity equals to net income over sales multiplied by sales over total assets multiplied by total assets over average shareholder equity. This can be simplified as the net profit margin multiplied by the asset turnover multiplied by the equity multiplier. Now, to put this into perspective, we have an extract from the 3 years of the annual report, that is from 2021, 2022, and 2023. We extracted the net sales, revenue, assets, and the equity of Standard Chartered Bank Zambia. When it comes to calculating the return on equity, we discover that for 2021 we have 31%, and then it drops to 25% in 2022, and then the return on equity in 2023 skyrockets to 42%. I'm sure you can see these changes. These changes are showing us the volatility of the return on equity for Standard Chartered Bank Zambia. From here now, we can move to the profit margin analysis, where we're going to analyze the net profit margin, the operating margin, and the gross margin. So here, the net profit margin formula is profit for the period over the operating income. So we can see here the calculations. We have provided calculations for 2021 up to 2023. That is for the net profit margin, operating margin, and the gross margin. We observe that the net profit margin declined from 26.77% in 2021 to 20.47% in 2022. Again, we see an increase from 20.47% to 30.42% in 2023. So when it comes to net profit margin, we're trying to measure how well the company does in terms of control over its assets and how it can, we're looking at how well the company does in terms of control, in terms of its cost, and its ability to control revenue into profit. So here we're trying to look at the reflection between the pricing strategy and operating expenses that might exist for a particular company. We move on, we look at the liquidity and solvency ratios. When it comes to liquidity and solvency ratios, we have the current ratio, and then we see that for the current ratios in 2021, 2022, and 2023, we can see that the current ratio remained low at 1.01 in 2021. We can see this one here, and then we observe that there was an increase in 2022 to 1.04, and then there was an increase in 2023 to 1.1. So here we're looking at the ratio of the current assets to the current liabilities. For the quick ratio, we can also see that it is mirrored in terms of the trend. We can see that this is a pure reflection of the current ratio in terms of the trend that has been carried out. So here we are looking at the company's ability to quickly convert some of its assets into cash. So we have cash plus marketable securities or plus receivables compared to the current liabilities. So now we can see the calculations have been provided here. So these calculations were done by us. We can now move to look at the cash flow. We can look at the efficiency and activity ratios. So here we're looking at issues like the asset turnover. So we can see that the asset turnover has consistently been low from 2021, where it was at 0.10. In 2020, 2022, we saw a decline, and in 2023, we saw the decline continue. We saw actually an increase. So in 2021, we were at 0.1, in 2022 at 0.08, in 2023 at 0.09. So the asset turnover measures how effectively the company uses its assets to generate sales. So here we're looking at a measure of the management's ability to utilize the investment in terms of its assets. We move on, we look at other ratios. We look at the common size analysis in our case. So for the common size analysis, we're going to focus on the common size income statement and the common size balance sheet. So the common size income statement expresses each line item as a percentage of revenue. So each item that we have here, that is the interest income, we're looking at it from the perspective of the revenue. So here we're able to see the calculations that have been provided here, that is for 2023, 2022, and 2021. So we're looking at each item, being looked at it from the perspective of the group. When it comes to the common size balance sheet, we show each item as a percentage of the total assets. So now we can see that we have a trend where we're looking at a widening gap between the company's rising profits and its deeply negative operating cash flows. So we can see that while the net income grew from 353.93 million in 2021 to 599.74 million in 2023, cash flow from operations remained negative. That is for our cash flow analysis. We can now move further and look at the earnings quality and the potential red flags. So we can see that Standard Chartered Bank Zambia's earnings quality is moderately low. We can see that it enjoys profits from 2021 to 2023. However, these profits were not backed by strong cash flows but they were just heavily influenced by large non-cash accruals and one-off events. An example that we might look at is the past COVID-19 era, the impairments that happened in 2021, an artificial low impairment charge, and the property sale gain in 2022 is what actually led to a substantial release of loan loss provisions in 2023, and this is what boosted the year's income. This pattern is very volatile for Standard Chartered, and such non-recurring item makes the bank's true sustainable profitability difficult to determine because of that. We can now move on and look at comparisons between net income and operating cash flows. So a major concern is the growing disconnect between Standard Chartered Bank's rising profits and its deeply negative operating cash flows. So here our focus now we're looking at um, Standard Chartered having a net income growing from 353.93 million in 2021 to 559.74 million in 2023, and then the cash flow from operations still remained negative, worsening to negative 1.1 billion kwacha in 2022. This indicates profits are just fueled by non-cash items like provision reversals rather than actual cash generation for Standard Chartered Bank. Having done our analysis there, we can now move on to look at the IFRS versus US GAAP considerations. So Standard Chartered Bank reports under IFRS. So in Zambia, those governed by SIGA is that we operate under the International Financial Reporting Standards. Even the headquarters of Standard Chartered in London, they also operate under IFRS. So you see there's a difference in terms of the IFRS and the US GAAP in ways that can actually impact financial analysis. The most significant is how the divergence in terms of the impairment accounting. In IFRS, according to IFRS 9, there is the use of a stage expected credit loss model, which can actually fully delay the loss recognition. Whereas for the GAAP, it requires immediate lifetime expected losses. So here you can actually have a situation where you can actually see early and potentially larger divisions in terms of losses. So here, if we're looking at it from the perspective of Standard Chartered, we'll be able to see that the bank's recent profit boost from impairment releases might not have occurred under the US GAAP. So because they're using the IFRS, you have that boost in terms of profits. But if we're using the US GAAP, we might not have that profit. So now here is a situation where we now have concerns and questions about the earnings quality. Moving on, we discover that in the IFRS 16, the requirements for all leases on the balance sheet, this will actually lead to increasing reported leverage compared to the US GAAP. So here what you have is a situation where the US GAAP will maintain an operating lease distinction. So these differences make profitability and leverage appear more favorable under the IFRS and complicate cross-border comparability for investors who might actually be assessing true risk and performance. So if we're looking at it from the IFRS perspective, then Standard Chartered is doing well. But if we're going to look at it from the US GAAP, Standard Chartered might have some problems in terms of the considerations of treatment. Now, in conclusion, the financial analysis that we've done reveals significant risk in terms of the Standard Chartered Bank's financial statements. So here we have negative cash flows, low earnings quality, which have been driven by non-recurring items, and potential overstatement in terms of the profitability under the IFRS. These factors make it a very unsuitable investment for the retired investor. Therefore, on our part, as before, we made the conclusion to say the investor should avoid So we are hoping this analysis will provide a clear picture of the risks that have been associated with the investment that the individual might take in Standard Chartered Bank. We thank you all for your time in watching this video, and we are open to suggestions and questions and also contributions. Otherwise, thank you very much. Please find attached the link to the financial statements in the comment section. Thank you.